Welcome to this lesson. I'm CPA Gaitho. In this lesson, we are going to learn about accounting transactions, accounting journals, and journal entries. Kindly remember to subscribe to this YouTube channel, Treatise of Accounting Information System. Leave a comment, share widely, and also hit the notification bell so that you can be reminded of any upcoming videos. This lesson's objectives is to learn about accounting transactions, accounting journals, and journal entries. In accounting transactions, we are going to define an accounting transaction and discuss various types of accounting transactions and classification of business activities. In accounting journals, we are going to define an accounting journal, purposes of accounting journals, characteristics of accounting journals, and discuss various types of accounting journals. In journal entries, we are going to define a journal entry, discuss features of a journal entry, and various types of journal entries. An accounting transaction is any business activity that has a direct monetary impact on either the financial performance or the financial position of an entity. Accounting transactions are gathered through the source documents. Accounting transactions can be classified based on, first, institutional relationship, that is, internal transactions and external transactions. Second, based on exchange of cash, that is, cash transaction, non-cash transaction, and credit transaction. And lastly, based on objectives, that is, business transaction, non-business transaction, and personal transactions. External transactions are transactions that involve exchange of goods, services, or works with other parties, such as sale of goods and purchases. On the other hand, internal transactions are transactions that involve internal processes, such as computation of employee salaries and estimating depreciation of assets. Cash transactions are transactions that involve exchange of goods, services, or works with cash and cash equivalents. These are transactions that involve use of cash money, bank transfer, or checks. Credit transaction can also be called deferred cash transaction since they involve exchange of goods, services, or works with a promise to pay at a future date. Non-cash transactions are the accounting transactions that are neither cash transaction nor credit transaction, such as donation of assets. Business transactions are transactions that are related with day-to-day activities of an entity, such as sales, purchases, rents, and advertisement. Non-business transactions are other transactions that are not related with day-to-day activities of an entity, such as donation of assets and corporate social responsibilities. Personal transactions are transactions that are performed by an entity for personal welfare and purposes, such as wedding gifts and benevolent expenditure to employees. Accounting transactions arises from business activities. Business activities of an entity can be classified into four, that is, operating activities, investing activities, financing activities, and liquidity activities. Operating activities are daily activities of an entity that involves production of products, selling them to generate revenue, and general administrative and maintenance activities in an entity. Operating activities involves selling and distribution of goods and services, purchasing and procurement of goods and services, production of goods, customers handling, suppliers handling, inventory management, general operating expenses, employees payroll computation, and payment of taxes. Investing activities are activities related to growth and expansion of an entity by buying and selling of long-term assets and other business investments. Investing activities involve management of non-current assets, construction of capital projects, and long-term investments. Transactions that are related to non-current assets are acquisition and recognition of assets, depreciation and amortization, revaluation and impairment, and disposal and recognition of assets. Transactions that are related to construction of capital projects are mobilization of deposits, works completion, retention of payments, and reimbursement of expenses. Transactions that are related to long-term investments are investment in subsidiaries, associates, and financial assets, business combinations such as mergers and acquisition, and joint arrangements such as joint ventures. Financing activities are activities that focuses on how an entity raises capital through debt and equity, as well as how it pays back the investors. Transactions related to equity financing are subscription of capital, issue of shares, distribution of profits, transfer of shares, and redemption of shares. Transactions related to debt financing are borrowing and repayment of loans, hire purchase and installment purchase, lease financing, issue of debentures and bonds, management of funds and customers' deposit. Liquidity activities are activities that focuses on ensuring that the entity has adequate cash to meet its financial obligations as and when they fall due. Liquidity activities involves management of cash flow as well as planning, budgeting, and forecasting. Transactions related to management of cash flow include banking transactions, that is, bank deposit and bank withdrawal, investing excess liquidity in short-term investments such as money market, and planning for shortages by taking a standing overdraft. Normally, the activities related to planning, budgeting, and forecasting do not directly affect either the financial position or financial performance of an entity. Hence, the activities may not give rise to accounting transactions. Accounting transactions are gathered through the source document and recorded in the journals before being posted to the ledgers. An accounting journal is a diary for registering details of similar financial transactions before they are posted in the principal books of account. Accounting journals are also known as day books, subsidiary books, books of original entry, or prime books. The purposes of preparation of journals in accounting are to record information directly from the source documents for future reconciliation of accounts, to transfer financial information to the ledgers and the ledger accounts, to summarize related daily transactions at one place, and to ensure compliance with the rules of double entry. Journal entries are recorded in a chronological order of date and time of when the transaction happened. A journal is a day book where day-to-day transactions are recorded. Characteristics of journals. A journal is a book of original entry. That is, journal is the first book of account where accounting information is recorded. Journal entries are recorded directly from the source document, hence they are original and authentic. Journal entries follow standard rules of double entry. Every journal entry transaction has two effects in the books of accounts, that is, a debit and a credit. In journals, it is possible to have a compound entry, that is, more than two similar transactions occurring on the same day can be compiled together to form a single journal entry. Journals are assistant to ledgers, that is, ledgers are prepared from the information disclosed in the journals. Journal entries have a narration. Every journal entry has a brief description that explains the transaction in clarity. Transactions identity. Journal entries preserves the evidence of each transaction and makes it easy to identify every business activity through its date or other essentials such as unique identification number in the source document. Sequential control. Journal entries are recorded in a sequential order that helps in identifying the unrecorded source documents, hence useful in reconciliation. Journals are broadly classified into two, that is, general journal and special journals. A general journal is a book of original entry whereby all other transactions except the one recorded in special journals are recorded. General journals are recorded using the rules of double entry. A special journal is a book of original entry for recording and analyzing a specific business transaction such as credit sales and credit purchases. Special journals are used to differentiate specific business transactions so that they can be handled, managed, and controlled in a better way. In a general journal, every transaction has at least two entries, that is, a debit entry and a credit entry. The details of a general journal transaction are transaction date, accounts affected, ledger folio, debit amount, credit amount, and a narration. The most common special journals are six, that is, sales journal, sales returns journal, purchases journal, purchases returns journal, cash receipt journal, and cash payment journal. A sales journal is a book of original entry that is used to record only credit sales, and it is supported by customers' invoices. Sales journal transaction details are transaction date, customer accounts debited, ledger folio, customer's invoice number, and amount. At the end of the day, the totals of sales journal are credited to sales account. A sales returns journal, also known as return inward journal, is a book of original entry for recording goods returned by customers, and it is supported by a credit note. Sales returns journal transaction details are transaction date, customer's account credited, ledger folio, credit note number, and amount. At the end of the day, the totals of sales returns journal are debited to sales returns account. A purchases journal is a book of original entry for recording credit purchases, and it is supported by suppliers' invoices. Purchases journal's transaction details are transaction date, supplier's account credited, ledger folio, supplier's invoice number, and amount. At the end of the day, the totals of purchases journal are debited in purchases account. A purchases returns journal, also known as returns outward journal, is a book of original entry for recording goods returns to suppliers, and it is supported by a debit note. Purchases returns journal transaction details are transaction date, supplier's account debited, ledger folio, debit note number, and the amount. At the end of the day, the totals of purchases returns journal are credited to purchases returns account. A cash receipt journal is a book of original entry for recording inflow of cash received from any source, and it is supported by a cash receipt. Cash receipt journal transaction details are transaction date, details of the accounts credited, ledger folio, receipt number, mode of payment, mode number, discount allowed, cash amount, and bank amount. At the end of the day, the totals of cash receipt journal are debited in cash book. Lastly, a cash payment journal is a book of original entry for recording disbursement of cash from an entity. A cash payment journal is supported by a payment voucher. Cash payment journal transaction details are transaction date, details of the account debited, ledger folio, payment voucher number, mode of payment, mode number, discount received, cash amount, and bank amount. At the end of the day, the totals of cash payment journal are credited in cash book. The differences between special journals and general journals are special journals records only similar transactions such as credit sales, while general journals records all other unrelated transactions such as depreciations and adjusting entries. Special journals are suitable for organization with numerous similar transactions, while general journals are suitable for organization with a few transactions. A transaction in a special journal has only one entry, while a transaction in a general journal has at least two entries to complete the rules of double entry. At the end of the day, transactions in the special journal are posted in both special ledger and general ledger, while transactions in the general journal are posted only in general ledger. Lastly, in special journals, transactions are accumulated and posted in the ledger as one batch amount, while in general journal, transactions are posted in the ledger individually. A journal entry is a log of financial transactions of an entity. Every accounting transaction has at least two journal entries, that is, a debit and a credit. There are 6 types of journal entries, that is, simple transaction entry, compound entry, adjusting entry, reversing entry, opening entry, and closing entry. A simple transaction entry is a journal entry for recording ordinary business transactions in the books of account that involves only 2 accounts, that is, a debit account and a credit account. On the other hand, a compound journal entry is a journal entry that combines 2 or more similar transactions made in the same day. For instance, repayment of loan plus the interest, payroll expenses with paid taxes thereof, and depreciation of multiple classes of assets. In compound journal entry, it is possible to have more than one debit account, more than one credit account, or more than one of both debit and credit accounts. An adjusting entry is a journal entry for making end-of-year adjustments in the ledgers in order to recognize accrued revenues, deferred revenues, accrued expenses, prepaid expenses, contract assets, and contract liabilities. On the other hand, a reversing entry is a journal entry made at the beginning of the year to reverse selected entries that were adjusted at the end of the previous period in order to recognize them in the current period. Such reversing entries includes reversing prepaid expenses and reversing deferred revenues recognized at the end of the previous period. Opening entry is a journal entry for recording balances of assets, liabilities, and equity brought forward from the previous accounting period. Lastly, a closing entry is a journal entry for transferring balances from temporary nominal accounts into permanent accounts in the balance sheet. It involves transferring of balances from revenue, expenses, and dividend accounts into balance sheet. Closing entries ensures that nominal accounts begin an accounting period with 0 balance. Features of a manual journal entry transaction are date of the transaction, accounts detail, ledger folio, debit amount, credit amount, and a narration, that is, a brief description of the transaction. From this sample manual journal, we are able to see there is transaction date, accounts detail, ledger folio, debit amount, credit amount, and the narration. Features of computerized journal entries are journal entry identification number per entry, transaction identification number per transaction, date of the transaction, general ledger account affected, subsidiary ledger account affected, type of source document used, unique identification number of the source document, type of the transaction, that is whether it's a debit or a credit, narration, that is a brief description of the transaction, debit amount on the respective account, and credit amount on the respective account. From this sample computerized accounting journal, we are able to see that there is journal entry ID, transaction ID, transaction date, general ledger account, subsidiary ledger account, source document, reference number to the source document, type of the account, narration, debit, and credit. You can also see that every transaction has 2 or more journal entries. Thanks for watching. Remember to subscribe our channel, Treatise of Accounting Information Systems. Like this video, leave a comment, and share with others.